Hello, today is April 28th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Willms, and I am the President and CEO of the Milwaukee Company. And joining me this morning is Dr. Dimitri Delis, who is the Managing Director of Piper Sandler Financial Strategies. And today, Dimitri and I will be talking about whether America is overdosing on debt. Good morning, Dimitri.
Good morning, Andy, and thank you for inviting me here so I can share some of my thoughts on overdosing on debt.
Well, I very much enjoyed the article you wrote on the subject, and I'm sure my audience will love to hear your commentary as well. Before we get started, let me just please remind everybody that this podcast is for informational purposes only, and that the views expressed in today's podcast are Dimitri and my personal views, and not necessarily those of the Milwaukee Company or Piper Sandler Financial Strategies.
Yep.
And with that being said, as I mentioned just a moment ago, you recently published an economic brief that suggests that America may be overdosing on debt. Why are you concerned?
Well, first of all, when you borrow money and you use debt, it can be a good thing. I mean, you buy a house, you can get an education, you can open a business. The problem is when you borrow debt and you don't use it for productive purposes, that's when the real problems start. And right now, I think the U.S. for the longest time, in my view, has been on that track. And I am concerned more lately because we've seen a phenomenal increase in the amount of debt that the U.S. has accumulated. I mean, I can tell you this, that up until now, it used to take years before we accumulated $1 trillion debt. Now it only takes months.
Yeah.
In the first 6 months of 2021, this year, I mean, fiscal year, so it started back in October until now, the deficit surged to a record of 1.7 trillion. That is more, 1 trillion more than what we had last year this time between October and March. So, I mean, the debt is increasing at a very, very rapid pace. And the thing is, last year, for the total year, our deficit was about $3.1 trillion. That's, from an absolute value, that's a record level. And this year, with the latest act that was passed here, the American Repair Act, I believe that according to forecasts from the Congressional Budget Office, as well as the Committee for a Responsible Federal Budget, they're estimating that our deficit is going to hit $3.4 trillion. So we are going to have $3 trillion deficits 2 years in a row. I mean, you're looking at $6 trillion out of a GDP, which is $22 trillion. That's more than 25%.
You made an early comment that I really found interesting and on point. You said sometimes incurring debt is good, but that assumes you're using the debt, you're incurring the debt for a good reason, right? I mean, like, there's a big difference.
That's the thing. I mean, if you go back in our history, and you'll see that every time we have a financial crisis, it's because of very bad debts out there. You want to talk about the housing crisis in 2008? What happened? People were just borrowing money and flipping homes, buying homes, second, third homes, and they were doing that on debt. Before that, we had the dot-com bubble. They were buying stocks on margin. And if you go even further back, I mean, you could go back to 1873 crisis, the railroad crisis. People were borrowing, speculating again, or during the Great Depression. The point that I'm making is when people borrow money to speculate, only bad things can come out eventually.
And now we're having the government be the borrower, and they're not investing money productively. It's as if they're borrowing the money and then they're throwing a party with it almost. It seems to me, because we're not. Now we're finally talking about borrowing money to pay for infrastructure and that sort of thing. Of course, there's a lot of things in the infrastructure bill that have nothing to do with infrastructure, but that's a whole other topic. But you're right. I mean, the biggest concern about all this debt spending is that the government isn't putting that money to work in as productive of a way that they can really, in a productive way in which they can expect a return on that investment.
Yes, that's absolutely right. I mean, if you go into the details and you look at the money that they spent under the CARES Act, under the $900 billion stimulus that was passed back in December and the most recent 1.9, I think about 75 to 80% of all that money that's in there is used for non-productive purposes. Granted, I mean, COVID is something that hit all of us here. And the thing is, I think we have to help people that got hit the most here. But the problem at the same time is two things here. One, we're going to have to pay back this money, even though we use it for good purposes. But at the same time, there's a lot of parts of this bill that are excessive and unnecessary. And by that, I'll refer to some of them. For example, we want to help people that lost their jobs last year in the hospitality and the restaurant business, and I understand that. Give them direct payments. But then to help them overcome this short, gap of losing their job until they get back on their feet. But then the government last year and this year, they're giving money to people that haven't lost their jobs. Right. I mean, people that make all the way up to $150,000. Why? Right. They haven't lost their job. Why are they getting $1,400? Why are they getting $1,200?
Well,
I just don't understand that.
I agree 100%. I think all of us, both you and I and everybody listening here, knows of multiple occasions where people got, either stimulus checks or loans that forgiveness, they borrowed money for their business and then had it forgiven, or a variety of other ways that people have benefited from all this government spending where it wasn't really truly needed. And of course, it's easy to, we could be accused of, Monday morning quarterbacking in a sense. And I get that, the government, a lot of our leaders decided it was best to take a very broad shotgun approach in hopes of making sure that we didn't not go far enough, like some people feel happened in 2007, 2008. The government didn't go far enough, and that's why the recession lingered. I get all that, but the point being, the point remains that this second time around, we should have known better, right? I mean, the economy's already recovering. We could identify where workers were most hurt and weren't, and those that weren't that adversely affected. Hell, you could have just told people, listen, check a box if you've lost money, return a postcard if you need financial assistance before you send them the check. I think a lot of people, wouldn't have sent that postcard back because they wouldn't have felt right about it. So, it does seem to me a very overly extended reach here, and it does concern me too. But why should we be worried about it? What's going to happen? What can go wrong? I mean, I guess.
Well, ask anybody out there that's declared bankruptcy what can go wrong.
Yeah. The difference there, of course, Dimitri, is that an individual can't print money. The United States cannot go bankrupt. It's impossible for the U.S. to go bankrupt because all of their debt is denominated in U.S. currency, and so the U.S. can print more currency anytime it wants. It's not like some third world nations who have to have their debt, put in dollar terms because nobody would accept them.
So, Andy, you sound like you are a proponent of the modern monetary theory. Is that right?
Well, no, I'm not. I'm just playing devil's advocate here. I mean, so what's your answer to the MMT, modern monetary theory? And by the way, for our audience, this is a school of thought that's been around for a while, but has gotten really popular. And the school of thought basically says, hey, deficits are not a problem. Government deficit spending is not a problem. We don't ever have to pay this money back, and don't worry about it. And there's some pretty smart people who have bought onto this whole theory. What do you see wrong with it?
Well, I see a lot of things wrong, but let me refer back. You mentioned the little note that I wrote that I put out a couple of weeks ago.
Yep.
On overdose debt. In there, I did an analysis where I estimated that how much for every dollar of debt that we add or we take on, we're supposed to grow our economy. So back in the 70s, for every dollar of debt that we borrowed and we added onto our debt, for every single dollar, our economy grew by $3 to $4. Well, right now, for every dollar of debt that we take on, we're growing our economy by 70 cents. Yeah. To me, that doesn't sound like a good deal. No. I'm putting $1 and I'm getting 70 cents back.
Right. Yeah, I see your point, and I think we also have to wonder if, at some point, won't increasing the amount of money in circulation affect the value of the money that is in circulation? Right now, it hasn't been much of an issue, because people have been saving that money. They've been putting it into the markets. Anybody who's followed the games stop saga knows that there's a lot of money, a lot of stimulus checks that people have uh, invested in penny stocks or high flying stocks. But
And
sooner or later, that's going
yes,
to stop.
everybody has been making money, and the
Right.
reason obviously everybody's been making money is because of the Federal Reserve and what they've done. Obviously, on the one side, we do have the fiscal response, which is the federal government borrowing more, or close to $5-6 trillion. On the other hand, you have the Fed and their balance sheet, which they also expended. What, they were 4 trillion, now it's 8 trillion. They expended their balance sheet by about 4 trillion. It's the amount of liquidity that they have injected into the system that is obscuring what true valuations are out there. And in my experience, what I've known is, there's no such thing as a free lunch. At some point, you're going to have to pay for that. Right now, anything that you touch in the markets, whether you look at the bond market, you look at the equity market, you look at M&A activity, IPOs, is going up. Why? Because of the amount of liquidity. It doesn't matter if it's junk bond, high yield bonds. They're all seem to, the amount of liquidity seems to be, hiding everything for now. But at some point, when the water recedes, you're truly going to find out what the emperor is wearing.
Yeah. Well, that's true. No, well, but then again, plain devil advocate again. The modern monetary theorist would tell you, look at, we've heard you guys, you are conservative fiscal hawks. We've heard this from you before. When 2007, 2008, when the government injected a bunch of money into the economy to fight off the Great Recession. And the predictions were then that all this money being injected into the system would result in new high inflation, and yet it never happened. So why do you think this time is different? Why do you think this?
Well, what I think here is, first of all, for now, I mean, this is how I think things will unfold. In terms of the aspect of inflation being runaway, I mean, everybody says that inflation is a monetary phenomenon anywhere and everywhere. And a lot of the people, that I talk to obviously lived through the 70s and the 80s, and they are aware of the double-digit inflation that they experienced. And they take that experience from 30, 40 years ago, and they try to project it today. But there's a big difference between then and now. Back then, what did you have? You had a manufacturing economy. It was a manufacturing economy. It was a closed economy. And by closed, I mean, going cross-border, it wasn't as easy as it is today. Where today, what do you have? You have a globalized economy. You have an open economy. And the more important thing is, this is no longer a manufacturing-based economy. It is a service economy that is based on automation. I mean, and by that, to give you an idea, for example, back then, if I published a book, or if I tried to print a book, or I wrote it on my own, it would cost, it would take a certain effort to reproduce it in the thousands, correct? Today, I can type something on my computer and create a book, and it doesn't cost me that much, and I can create millions of copies out there. Which means, which way is my inflation headed? It's headed to zero. So the point that I want to make is, you are comparing two different environments, and automation on the one hand, along with globalization, will continue to pressure inflation prints lower. Now, the problem that everybody, and I know everybody's worried about inflation and where it's headed. And I can tell you, at some point, inflation, higher rates will hit us. And what is that point that will come? I don't think higher rates are going to come because we are going to experience higher inflation anytime soon. I think higher rates are going to come when the people that we borrow money from, they're going to start questioning the ability of the U.S. to pay back its debt. Right now, what's controlling the ability of the federal government to pay the debt is the Federal Reserve, which they have rates at zero. By having rates at zero, you're paying very minimal amount on interest rates. I mean, if you go back, I don't have the numbers with me, but I can tell you right now, because our because rates are so low across the curve, we are paying less interest now than we were paying 3 or 4 years ago, despite that we jumped by $6 trillion. Right. Why? Because rates are so low. And as long as rates remain low, obviously the federal government can pay its debt. It's like you going to the bank, and as long as the bank feels comfortable that you can pay back, make your payments, they will keep on lending to you. At the moment, they feel, yeah, go on.
Well, I was going to say, let me say that I have a little bit different perspective on this, and so it'll be interesting to see how this plays out. But in my mind, I think inflation is a concern, and I think it is related that we may very well see higher inflation rates as a result of the loose monetary policy that the Fed has been following and the spending that the fiscal policy that Congress has been following. And this is my thinking. Right now, I think the main reason we haven't seen inflation increase is because there hasn't been a corresponding increase in money supply hasn't been accompanied by an increase in demand. So we've had consumer demand, industrial demand all stay relatively level. So that money that the government has been injecting into the system hasn't found its way into the economy. People aren't spending it. Where's it going? It's going into savings. There's a massive jump of money that's gone into savings, and it's gone into the stock market and other investments. So as long as that money, if we could say that'll always be the case, that all this government stimulus will find its way into saving accounts and into the markets, we probably wouldn't have as much inflationary pressure. But I don't think that's going to happen. I think people are going to use the savings that they've accumulated as the economy starts to open up and start spending some of it. And likewise, I think what's going to happen in the markets is that there will be a bear market at some point here, and some of these high-flying stocks will crash. And when that happens, people are going to get gun shy. Right now, new investors never saw a bear market, but they will. And when they do, I think you're going to see them pulling all of that money out of the market and putting it into the economy. And when that happens, I think inflation will start to rear its ugly head. And then the Fed's in a position where it has to make a decision. Does it go against what they promise? The Fed's number one tool for fighting inflation is interest rates, right? They have to raise rates to lower demand, but they've already promised they won't do that. They said, we're not going to raise rates for the foreseeable future. If they can't raise rates and inflation is starting to show, what's going to happen? Well, inflation could spiral out of control. I lived through the very, very high inflation rates in the 70s. I bought my first home. I was thrilled that I was able to get a mortgage at 10%. I thought that was just and that had represented a large drop in rates, which made it possible for me to do that. So ultimately, I think inflation, we do have a significant risk. And when that inflation really if it starts getting to the 3, 4, 5% level, the Fed is going to tolerate some higher rates for a time. But and I'm not predicting this, I'm just saying if it does happen, the Fed's going to be forced to raise rates. And that's going to be the pressure that causes rates to go up. It's going to be the Fed having to start to tighten because inflation will start to grow at some point down the road here. But there's a couple of different ways this can play out. We're in very much unprecedented times. Yep. Whether or not, I hope I'm wrong. Gosh, I hope I'm wrong.
Well, Andy, I mean, you can look at Japan, for example. They have their debt to GDP ratio is probably over 200%, 250%. They have no inflation. They're 10 years on zero.
But there's a good reason. There's a big distinction between us and them that I think explains that. They have a totally different culture than us, Dimitri.
Well, they do have a different culture, but
so their savings if you look at their saving rates, it's much, much greater than ours. But so their savings, if the money goes into savings, it's not going to be inflationary. It has to go into circulation. In Japan, if you look at their money in circulation, it hasn't increased. It stayed consistent. And there's two reasons: their culture and because of their demographics. They have had a much older population, and their older population is much more reluctant to spend. you see now you say, well, Andy, our baby boomers are they're good. That's a big block of we're having more of them relative to, but baby boomers are much more willing to spend, and they spend on all kinds of different things that the Japanese senior citizens don't. We spend on travel. We spend on housing. They spend on pets, an amazing amount on pets. So just Japan is a reflection of their country's makeup, and ours is different.
I believe there's more than just that, and I think a lot of it also has to do with globalization. Because yes, people got money and they will spend it, but it's not that they're going to be getting money from the government every year. They're going to be spending it. It's a one-time shot. So yes, they're going to spend it, and you will get a spurt in growth and inflation. But once that money's gone, prices are going to come back down. What really, if you want to get a sustainable growth on inflation, the way you saw it in the past, and what you need to see, you want to see wages go higher. As long as wages are not going higher, because that's the only income that comes to people on a recurring basis. If their salaries on a recur every year start getting higher and higher, that is going to create inflation. Getting money one time from the government, even though I realize it's an unprecedented amount out there, it will create a spurt in growth. But once they use it up, inflation is going to drop back down. Now, if wages start moving higher on a sustainable basis, that's a totally different ballgame here. And the thing is, what you see with wages right now, because we live in this globalized world and capital always moves in a country where it can be more efficiently deployed, you're not going to see wage growth. And I think part of the reason why Japan is there is because of globalization. Why the U.S. is like this is globalization, which is keeping wages low. I mean,
I agree with you 100%. I agree with you 100% on the wage picture. But then again, we're hearing there's a good deal of pressure to raise the minimum wage to $15 to $20 an hour, which would obviously create wage pressure all the way up the scale. So I don't know that you're right that productivity is greatly improved. Automation has made the productivity much greater than it was in the past. But that could very well be offset by people working less people in the workforce. We could go back to a society where you only have one of the breadwinner in the household instead of two, like we have gotten used to. So I wish I could be as optimistic as you are about inflation staying low, because to be honest, if I thought inflation was going to remain low indefinitely, no matter how much money the government prints, we don't have to worry about inflation. Then I wouldn't be. This whole situation would be a lot far less.
But you would be worried. But you would be worried if the government wasn't able to pay back its debt. That would create problems, because at that point,
how can they not pay it back when they can pay it back in dollars? Their debt's denominated in dollars, so they can always pay it back. They can always print more money.
Right. They can pay. Here's where the problem comes. They can pay it back because they can print more. But you and me as investors, when we see that's exactly what they're doing, we're going to say, hold on. I don't want 1.5 or 160 on your 10-year treasury. I'm not going to give you money for 10 years at 160. I want 360 and 460. And
why? Why will they want more interest? Why would they want
I want more interest because you're a higher risk, like a bank.
Not if inflation stayed. No, but I don't think that's true. See, that's where I don't know if I agree, because you're not in a higher risk of default. The U.S. can't default. What happens, I think we get to the same place, but for different reasons. What's going to happen is people are going to say, this dollar that you gave me isn't worth as much anymore. So, I mean, I can't make it on a 1.5% interest rate. My purchasing power has gone down because inflation you've put so many dollars into the system that each dollar is worth less. And so as each dollar becomes worth less and its purchasing power is diminished, that means I want more dollars in the form of interest to make the return on my investment the same as it was when interest, before you printed all this money. So, but there's, who knows? One way or the other, I think there's a good reason for to be concerned about interest rates rising, and that's why I've been encouraging our clients to try and avoid, try and keep their vulnerability to rising interest rates in their investment portfolios to a lower level than maybe they might in the past by, focusing on lower duration instruments and looking for alternatives to for generating counterweights to their equity allocations. So, but Dimitri, do you have any other ideas for investors before we sign off on how they might want to guard against this whole concern of the government spending
I agree
out
with
of
you.
control?
At some point, inflation will become a problem, but I don't think that's going to be an issue in the near term. But at some point, it will definitely be a problem, and I think you're going to see rates move higher. But over the next 2 years, my view is that we're going to remain in a very low interest rate environment.
Well, we could certainly agree on that. I'm not smart enough to time these kinds of things, so it could take it could be a longer time than 2 years down the road.
Yes, absolutely.
My investment horizon is always 5 years out, so I'm always trying to position myself for what's going to happen.
Andy, there is no doubt there's going to be a price to pay for all this.
Yeah, that's for sure.
There's no such thing as a free lunch. We know that for a fact. It's all about timing. I mean, and is it 2 years, 5 years, or 10 years? It's kind of hard to give you that answer.
Exactly. So, depending on what your investment horizon is, if you're not, that'll depend on what way you want to go or how you want to deal with this. But one thing we can agree on is that equities do tend to do very well in a rising interest rate environment and might actually prove to be a safer place than some of the other more traditional safe havens if the government's policies continue in the direction that they're going now.
Yeah, I mean, if they keep on pumping money and growing their balance sheet, because that has been liquidity has been the primary driver for equities. It hasn't been earnings. It hasn't been GDP. It hasn't been wages. I mean, and as long as investors, are chasing this dream, because pretty much the dream at these levels, and putting their money, you're safe. But the question is, at what point do they stop believing? And they're saying, okay,
Right.
The Fed has done too much. These are not real valuations, because our history is replete with examples. I mean, starting with the tulip mania in Holland. It's the same thing. People are willing to buy tulips as long as they know there's somebody else that's willing to buy from them for a higher price.
Yep, you got it.
Once that person goes away, this is just going to, it's like a deck of cards stack is just going to crumble.
I hope that's not the case, but I certainly share your concerns. But once again, I hope that doesn't prove to be the case. Dimitri, I want to thank you very much for joining me today. It's been a fascinating discussion. I very much enjoyed it, and I want to also remind our audience that they should conduct their own independent research before acting on any of the information or opinions expressed during this podcast, and that they should not act on anything you've heard or today without discussing it with a qualified financial professional who's familiar with their personal situation and investment objectives. And with that, I'll say thanks again, Dimitri, and thank you all for listening. And
thank you very much for having me, Andy, here. Thank you very much.
It's our pleasure.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.